Well, good evening, everybody, and welcome to the Hump Day Market Update. This is, we had to skip last week because...
Slacker.
So I'm a slacker, yes. I was on vacation, but I'm back, baby, and we are back, and of course, alongside of me, and she always is, unless she takes off, is
Unless I'm slacking.
our megalennial herself, Miss Nikki Ward. Nikki, you're such an angel. You have a halo, a green halo above you.
I am an angel when I'm sleeping.
Yeah, exactly. Okay, we'll ask your dad, because your dad is one of the few viewers of the show. He does. I mean, the good thing about your dad, he does get our counts up.
He said he would cut his hair for Maddie's wedding.
He did?
Because she FaceTimed me to tell me the news when I was at his house. Sorry.
Okay, so Jeff's going to cut his hair.
Story.
All right.
And also become the most eligible bachelor once he does. He'll look a decade younger.
Yes, he will.
Mm-hmm.
Yes, he will. And we like Jeff, which is Nikki's dad. And but you mentioned this. I didn't want to talk about that, but we will since my daughter got engaged, and that's all exciting stuff. So we are looking forward to cheers to that. We are looking forward to there we go. Looking forward to probably some kind of festive occasion, in late 2023. All depends on how Apple does, so we'll see.
I'm really excited for them.
No, this is a true story, though, and you know this. I'm just letting people know that my daughter was, she in college. She did well, and we didn't have to use her college fund, really. We were just, there was costs involved, but she had bright futures and blah, blah, blah. State of Florida has certain things. And so we really didn't spend any of her college money. So I took that college money and just dumped it before it was before college. We were just paying for it. But I put it in Apple. And I said, you know what, this will be her wedding / house fund, whatever, and it's been in there for, I don't know if it's 2011 on that one, but that's probably since 15 or 16.
Oh, it's got to be, because she graduated in 16.
She graduated in 16, so it's probably a few years before that. So anyway.
Thanks, Apple.
Thanks, Apple. And that is my motto. In fact, I told my wife that I would like to have as the goodie bags reveal little Apple bags.
That'd be cute.
I got to find. That was my idea, by the way.
That.
I love to find, and that's just the point, And if I could put one of the little search tags in there, really.
Oh, like an air tag?
Yeah, I mean,
you're just trying to keep tabs on all the guests?
No, I don't care about the guests, but I mean,
can you imagine how many freaking people you're gonna have to do that for?
Yeah, I know. There's gonna be a lot of people, so we will see. So anyway, but we're very excited, and It's something really, really good that we can look forward to in the next year and a half or so. But it is the Hump Day Market Update. And a lot's going on. We had September is really usually crappy for the markets.
It's a snooze fest usually.
Well, I mean, it's a snooze fest. I look at when the markets are flat, nobody's doing anything. But September usually is a bad month where markets do go down in September, and we didn't see that to get started. First of all, July was good. August was crappy.
Wait. June sucked.
July was good.
Better. August
sucked.
September sucked this week.
Do you remember? September has not been good, and we have the 21st of September coming up here, which is always the key to that song. Do you remember the 21st of September? Love that song.
Earth, Wind, and Fire.
Yes, it is. So this week, of course, Monday was calm, breezy. Nice, not bad. After the shortened week, the Labor Day holiday, we had a pretty good week where the markets were up.
Broad-based, too.
Broad-based. The S&P 500 up 3.5%. The NASDAQ up 4%. That was last week. And then, which brought the numbers down, or not as bad year to date. And then this week happens. Monday, we were up a little bit. Then yesterday.
Tantrum.
Yesterday, the market just did not like the CPI number. That's exactly what it was. And a CPI is the Consumer Price Index. And what that means, folks, is that is what we are paying the consumers, prices, what we're paying for goods and services at the consumer level. Then today, the Producer Price Index came out. Easy acronym, the PPI. That is what the producers are paying at their level. And the Producer Price Index usually will start getting better or worse before the consumer, because it does take time to get to the consumer level.
Correct. It's a leading indicator, and by the time it quote unquote trickles down to the consumer, you'll then see that cooling off hit the CPI number.
Yes. So let's talk about the numbers.
We saw a brief respite in the PPI means hopefully amongst all these inflationary pressures that the consumer is going to feel that relief coming up.
And the CPI was below expectations. They were expecting a year-over-year gain of 8.1%. It came in 8.3, so 0.2% more. The producer price index came in line.
Right.
And that number on the PPI year-over-year, do you know what that is? Wait a minute, I got it. It was 8.7, and this is versus 9.8. No, I'm sorry, 8.7 in line, but July was 9.8.
Right, I was going to say it's a significant pullback from July's hot rating.
So I think we're seeing it. I mean, things are working. And rates on the 10-year Treasury went up. So what does that mean? Mortgage rates are up. And here's what's interesting, folks.
New mortgage rates are up.
New mortgage rates, not your existing 30-year mortgage. But if you have a adjustable rate mortgage, whenever that anniversary, whenever your time to adjust, it's going to adjust upwards. So be prepared for that. If you have a credit line, those go up as the prime rate goes up. The prime rate right now is 5.5%. But the Fed funds rate runs at 2.25 to 2.5. They're going to raise 80% chance, 75 basis points next week. Next week's the meeting. That puts us at 3 to 3.25%.
And we talked about this earlier on our podcast that we recorded, but I think my forecast year end, we're going to see the Fed funds rate at 4.5%. And I think we're going to see CPI in the 6s. And for the last 8 rate hike cycles, the Fed has not stopped until that Fed funds rate has been above the CPI number.
So something's got to give. The Fed funds going up, but inflation's going to go down. So let's look at the number. So you think 4.5?
4.5 Fed funds.
Okay, so they have
2 more meetings
after next week.
September.
2 more meetings. So if they're up to 3.25. And if they go 75, let's say they go 75. Yeah, you think 1% next week. I don't think so because the Fed hasn't even mentioned that. But let's just say 75 basis points. That gives us to 3.25. Another 75, let's say. That's 3.75 to 4. It could potentially be 4.5 if they do a 50 basis point.
I think you're giving yourself enough room to
that could potentially be.
But I will say you were the one who the first time that the Fed hiked rates to 75 basis points. The first time that they did it, you were like, oh, they haven't even brought that up. They're not going to do it. They did it.
Yeah.
So
but I don't think
he's trying to put his money where his mouth is. And he's been very vocal that they're not thinking about the pivot. The market got ahead of itself, thinking that that's going to happen, that they're going to have to, reverse course on tightening.
And this is this is an absolute Fed-induced recession that we're having now.
The Fed has driven the narrative all year, and that's all they're going to do.
And you can't fight the Fed. However, at some point, and it's really when the market believes that the Fed is done raising rates is when the market's going to have that substantial rally. I think that and I keep going back to my book saying that we're going to rally year end and we're going to end the year down. Yeah. I say mid-single digits. That could be 5%, could be 8%, could be 3%. I don't know. Somewhere between 3 and 8% end of the year down.
I'm in that camp.
And then next year, because the Fed's raising rates, even though there is a 100% track record that every third year of a presidential cycle, the market's up 100% of the time. I think we will be up next year, but we may not have a big year. We may be up 5%, 8% next in 23. I don't know.
But after the volatility of this year, I think the key buzzword for me this year has really been volatility. Capitulation hasn't been mentioned as much, but that's the way it's felt.
Because you're not seeing the capitulation what they're looking at, where everybody's throwing in the towel.
That has not happened, or it did in June, maybe.
There was times where it felt like it, but it didn't last long.
And it's just going to be bumpy this year. I think next year, I don't think it's necessarily going to be smooth, but I do think we end the year up. Yeah. But I don't think we're going to hit it out of the park.
Well, by the way, on Sunday morning at 7:30, I'll be on Channel 6 locally with Justin Warmoth. And I believe it's at 7:30 a.m. and it's the weekly show at Justin Warmoth. And I know Justin very well, known him since he was a kid. So I look forward to doing that.
The Warmoth family they're just so nice.
They're incredible people and extremely talented, by the way.
I'll say.
When you have 2 kids play pro baseball, 1 kid play college baseball, 2 newscasters, and Mrs. Warmoth is a hell of a hairdresser. So
I should give her a call.
Yes, she's incredible.
My flyaways. My green halo.
You got to get rid of the green halo. Maybe somebody can do that. We can call somebody.
Thomas.
So look, the market yesterday had its worst day since June of 2020. Think about that.
It was ugly.
It had its worst day since when the pandemic.
We were locked in our houses.
Exactly. So that's not good. But bearishness is extremely high. Extremely high.
Which just means everyone's super negative.
And that's good, typically for the markets.
For us too, so we can take advantage.
By the way, yesterday, Home Depot, of the 1,200 points that the Dow dropped, Home Depot attributed to about 130 points of that.
I feel like they're being unfairly punished. I mean, I understand the housing market is slowing. There might even be a recession within the housing market, but Home Depot does not deserve that kind of a punishment.
Well, I mean,
people are still going to do upgrades.
Doesn't.
I'm personally going to buy paint at Home Depot to paint my upstairs. I mean, I'm not moving, but I'm still spending my money there.
Well, first of all, Home Depot now is trading at an extremely cheap multiple. It's trading at market multiple right now. Wow. How often have you seen Home Depot trading at market multiples? And you have earnings growth at 7% and 5% over the next 2 years, respectively. So, when you look at the down here at these levels at 276, first of all, here's the 52-week low. We're almost there. Almost there. And, significant downturn here. I mean, it really looks terrible. So I'm not a buyer just yet. I'd like to see the stock try to bottom. I'm really in a bad market like this. I really want to look at technicals and I get it. We can just go ahead and and if you want to take a half position, again.
That's the thing. If you want to get on the escalator or the elevator, it could be an opportunity to do so.
To average in, because we're not sure. I mean, the technicals look like crapola.
Garbage. So
the stock looks like it wants to go lower. The support on the stock is $264. I'll show you where that is right now. $264.
If it violates that, I'd say.
Yes, that would be a problem. $264 would be a major problem. Now back here, March of last year, it got down to $246. But remember where that was? That was a year after the pandemic. So look, we are in a situation at Home Depot. The earnings are being lowered, the guidance being lowered, and that's always a problem earnings-wise. But again, they're 17 times earnings. So
I wonder if they have issues with inventory as far as like a glut of inventory, like most of the retailers are.
A lot of the retailers doing that. They may, but still building is going on, even though the home builders are getting hammered.
But not to mention though, too. I mean, I watched Kathy Wood tweet about commodities, and lumber is down. I think it was like 60% from the pandemic high. That could be something also that is.
However, that's still up big from where it started. Yeah. I mean, they all still are up big. So
and that's if you can even get it.
Back then you couldn't, and now it's still taking time to get windows and things like that, because I have buddies that are home builders. So we talked about CPI, the PPI. Okay, those are major issues. Are the interest rate hikes working? It appears that they're working. It doesn't happen overnight, but one of the biggest problems in CPI is the housing market.
Shelter costs account for about a third of CPI,
yeah.
And I think it was. Within the month, it's up 7%. I mean, it's just nuts because rent is such a sticky inflation number.
It's not going to change right now.
No.
It's going to take now, if you look at Realtor.com, you look at Zillow, or if you have access to the MLS, if you're a realtor or have access to a realtor, you will see price reduction. Everything's getting price reduced because the party's over.
Right.
The party's over. Rates over 6%.
Exactly. That's the first time that has happened since 2008. So, I mean, we're seeing the majority of the people that were left at the party are first-time home buyers, people that are struggling with
and I feel bad for them because they're now basically screwed, because it's hard if they're looking to start buying a house in the beginning of this year. They can't afford what they were looking to buy now.
Right, because the mortgage has almost doubled their payment.
So, look, this is what the Fed's intent is.
Which then, real fast to jump back into housing. The fact that home ownership is out of reach forces people to rent for longer, and it also allows for landlords who, during the pandemic, weren't allowed, or they were, sometimes they weren't collecting the rent on time. There are a lot of assistance programs, but now they are raising up the rents because they can, because people need shelter, and so that it's such a sticky inflation number that the Fed can do nothing about,
right?
But is a huge addition to this inflation.
I saw a quote today from McDonald's. the heads up at McDonald's. I'm not sure who it was, but one of the
McDonald's is basically a real estate company. Too.
one of the officers at McDonald's, they said it's a major mistake, this $15 an hour thing, to go nationwide. I know it's going to take time for it to do it over the next couple of years.
God forbid we pay people a livable wage.
Well, I mean, look, I get it.
McDonald's has so much of their profit margin. Like, I don't cry for them at all. I don't lose sleep over them.
There are some jobs that may not warrant that type of
so automated
hourly. Well, if they could, they would. And I'm sure they're working on it.
Have you seen the Flippy?
I have gone to McDonald's, haven't figured out how to pay.
No. Okay. But
I know that.
Flippy is actually like he flips burgers on the not a stove. I don't know,
then that's what's going to happen. Is that it's going to they're going to automate.
Up those other people that normally would be doing that job to do something else, to become more proficient in another skill and get a higher paying job. And they should. There are wonderful things about raising them in a wage that hasn't been raised since I was like 9.
So let's talk about what happened today in the markets. Is a really volatile day today. Started up that we having a pretty good day. The producer price index came out. The PPI was in line. Market really didn't react that much, but it sold off later in the morning and ended up for the day. Today, the Dow was only up 30 points at 31,135.
Despite some scary shit about what could happen to our supply chain here in the United States.
We're going to talk about that too. The S&P 500 up 13 at 39.46, and the NASDAQ was up about 0.75%, which is not too bad. And what Nikki's referring to is the
potential strike,
the railways,
right? Which could really just take a supply chain that's already just,
already struggling
been through the mud and really wreak havoc.
I mean, the trucking companies are dying for more truckers and more employees. And now with the railways, I got the numbers here.
Yep.
That rails, and I got to look at this because it's really interesting. About 40% of the nation's long distance trade is moved by rail. So if the unions do intend to strike, it would make more than 7,000 trains would be idled.
This could cost our economy up to $2 billion in lost gross output per day. It's absolutely insane. 20% of grain in this country moves through rail. Half of fertilizer does. This is something that's also affecting passenger trains in certain areas because Amtrak uses the freight lines to transport people. I mean, this could really it could quote unquote derail almost everything.
No, it's a major issue here, and
all these people want is just some time off.
Exactly. You know what? I didn't realize that it's not about the pay.
No, because get this.
It's not about the pay, by the way.
They were offered a 24% pay increase by 2024. Mm-hmm. They said that's all well and great. We're still not even at the same table because what we care about is quality of life provisions. So they work on a point system for attendance. And it means that these workers can be on call for up to 12 hours a day. You have to be within 1 hour of your job site within those 12 hours. So these people aren't able to get accomplished all the silly little errands like running to the bank during the 9 to 5 or getting a dentist appointment. And they're being penalized for that. Simple things like taking
they
time
can't
off
even
for
do
a
that.
funeral. If you have unscheduled time off, that counts against you in the attendance point system. So like as life happens, something comes up, they get penalized for that.
Well, this is a chart of CSX, which is a major rail corporation. And if you look at it, the chart looks like an abomination. I mean, it doesn't look good. I've made money on CSX in the past. I have. I've done really well. And usually when I buy it down here, I've done well. I'm not going to go out and do it now because when you're fighting against labor unions, I don't think anybody can win there. So you got to really watch that. But this is something to keep an eye on. And then the president
start striking Friday.
The president and the cabinet are working on it, and they're involved now, and they've been involved for a few months. They're trying to talk to the companies and see what they can do about making things right. So who knows? Let's go to, I want to go a couple things. There's a listener question that we had from last time, and I also want to talk about your girl, Kathy Wood. And Kathy,
she's so excited to see us.
You know what? I like her a lot, actually. I think she's great at what she does.
She is.
Despite what we've seen.
She embodies what her fund is. She's a disruptor.
Yeah. And exactly. So during the bad, and she's got freaking stones. Okay, because when the market is looking its ugliest, she goes out and puts her money. She truly does put the money where I won't say her money where her mouth is, because I don't know how much of her money is invested.
A lot of it,
but she does put a lot of her money in there.
She started ARC with predominantly her funds.
Yeah. So, I mean, Kathy, on the worst day, went out shopping, and she went out and bought some Roku.
I don't know if I get this one though.
I don't either. I'm going to share the screen with you. This is what Kathy bought Roku. I mean, it's down so low. But here's the thing. Maybe she's thinking, and she continues to average down, and she does try to catch that falling knife. So I don't know. But she bought Roku. She bought Zoom, which I understand. Same thing. But I understand Zoom. I mean, this is a household name. I get it. But
it's only become a household name because of the pandemic. And now
this
that
is true.
We are reopening and entering back into the norm, I don't see Zoom's story, unless they can do a pivot and do it perfectly.
This is a Twilio, which is an enterprise software company. Big volume today, actually, in the upside. So up 10% today. And she bought it yesterday. So, I mean, that's a pretty good day for her. And the last one was DraftKings, which I know you were a fan of.
I am.
And they had a pretty good weekend.
It's football, baby.
It's football season, so they did a pretty good weekend. So,
although I do not want to talk about the Patriots-Dolphins game.
I haven't brought it up.
I know. I'm just saying.
And I did watch it. By the way, if you look at the chart on this, it's got its head bumped against the 200-day moving average. Literally right there. If it can get through that, and through $21.45 right here, you got wide open space. I mean, the stock can easily run to here, which is 30, low 30s. I mean, it's got some upside. So we'll see. But I think DraftKings does. That's probably an interesting play for the risk takers.
For sure, for the risk takers. I think no matter what, I'm looking at the long game, and DraftKings is, as well as FanDuel and sports betting generally, has just recently come into the fold as far as being accepted by Roger Goodell, the NFL.
Yep.
And so this is my long game play. I'm not really worried about this season, next season. I know that nothing is going to get in the way between America and football. However, I worry in the short term, if you don't have a time horizon measured in years, that this is not for you because of the fact that as consumer discretionary money dries up, you have to think people are going to pull back on sports betting. Like,
you would think
the subscriptions, like, you're thinking, if you're going to, within the budget, try and cut costs, that's
probably the first thing that
your
goes.
Your imaginary football team that you're the coach of, it's probably the first.
You mean fantasy?
Yes,
okay.
Which is what sports betting is.
You
fantasy.
call it an imaginary team.
It is.
It's not imaginary. Okay. It's real.
Yeah, it's your imaginary
team.
It's fantasy. You're the commissioner or the coach of.
Okay.
I'm sorry. Is fantasy not imaginary? Does it not all happen in your imagination?
Synonym. I used to play fantasy football.
Synonymous.
I used to be really into fantasy football. I just don't have the time anymore. But
it's a dedication.
It is a dedication. You got to know who's out, who's what. So, all right. So we talked about that. We talked about Kathy Wood. Let's talk. So we know the Fed's going to meet next week. We believe it's going to be 75 basis points, 80% chance. Nikki believes 100 basis points. I don't believe that. We have a bet that her and Justin think it could go 1%.
It's entirely plausible.
If they go 1%, then I owe them both lunch. If it goes 75 basis points, they owe me lunch.
And
they can split it.
So
yeah,
like,
because
really gives a shit.
The odds are 80% is going to be 75 basis points. So I have the higher odds, so I'll go ahead and pay put the risk out. So let's talk about the housing market, because when I go on to Justin Warma's show tomorrow, he wants to talk about that a little bit. Okay. The demand for home buyers, the mortgages for home buyers fell 29% over the last year.
Yeah.
And rates have gone, of course, over 6% right now. Here's what's really key. Refinances down 83% in the last year, same week, 83%. Think about you when you refied your house last time. Did you just refi for the interest rate, or did you pull a little bit of cash out to do something else? Upgrade your kitchen, do your bathrooms, whatever the case may be, pay off your car, credit cards. I don't care what it is. My point is, most people take some cash out when they refi their house. That is cash that goes right into the economy. That's not happening. That's not happening. In fact, Nikki, when I told you this number, this is an interesting number. Both you and Justin were a little bit blown away. With rates above 6%, only 452,000 borrowers in the country.
Out of 333 million Americans in this country.
So split it up into families. 100 million families. Let's just say. I don't know. I'm just guessing.
Less than half of a million.
452,000 borrowers can benefit from refinancing their homes, according to Black Knight, which is a mortgage tech and data provider. Think about that. This is the lowest number on record. On average, however, these folks, if they refied now, could, on average, save themselves $315 a month.
Which is not insignificant.
No, that's a good number.
Especially with, I heard a stat today that inflation currently is costing the average American household $450 more just to continue living at the same levels that they were last year. So the cost of living,
I thought the numbers were higher than that.
Inflation, on average, because gas has come down significantly since June.
Right.
You know, $5 to $3.90. But so what I think about when I think about those refinancers is like, okay, so the last time that 30-year mortgages were at 6.01% was 2008. So those 400 and something thousand people that could refi, they probably have their first mortgage in like 2006, 2007. Right there, they're at that 15-year. Maybe they're thinking, okay, I could refinance down. But also to that, why is it the lowest number on record? Is it because a record number already refied, or?
I think if you were going to refi and you wanted to refi, you already did. I think that the 452,000 that haven't refied, they haven't refied because there's a reason. Credit or job situation.
Okay.
They just couldn't pull it off. And I'm saying not all of it, but think about
that
it.
Makes sense. I mean, with job loss and income loss within the pandemic, it probably
we know the last couple of years
been
a problem. So that to me,
left holding the bag almost.
We have a listener question before we wrap things up, and then we'll briefly talk about a couple ideas. Joshua from Orlando, and we talked about this on the podcast today. Joshua from Orlando. This is a really common question we're hearing now.
That's relevant.
I saw my 401k statement this week and saw that it was down again. I'm not sure how much more of this I can take. I'm still working, and at 62 years old, I'm worried my money won't be there when I need it. What do you suggest? So, first of all, we don't have we need more information. First of all, we know he's 62. Second of all, we know he's still working. So let's just say we figure somebody at 62, retirement is in the horizon. It's close.
It's imminent. And not to mention, he said, I don't know how much more of this I can take, which hints to me that your risk tolerance is not aligning with your asset allocation within the 401k. Because
and
if
that happens, that is such a common thing, Nikki.
Oh, yeah.
We see it all the time. Clients come in and say, here's my 401k, and they are not aggressive, but and I want to ask you this question because it's rhetorical, but I mean, I know you know the answer. So I'm going to kind of ask it, throw it. I'm going to throw you the softball. I'll throw you a softball. How do people allocate their 401ks?
Well, what did better last year? What did the best last year? And then that's how I want to be allocated. But the reason that they do this is not because they just blindly pick. It's because they're not educated on this. They don't have an advocate that is working on their behalf. They don't even have anyone giving them guidance.
They're investing through the rear view mirror, which mine is very clear.
I mean, I don't know about you, but I got 20/20 hindsight.
And I got a backup camera too. So my rear view mirror.
It's so great.
So look, here's the thing. In 401ks, because that along with your homes are usually your biggest investments. And so it's important. And if you're 62 years old, you see on the horizon you're going to retire in 3 to 5 years, you probably shouldn't be 100% invested in the stock market because that's what most people are, because 401ks don't have a lot of selections, but most importantly, they don't have anybody advising them and telling them what to do.
Without a doubt. And we have the studies that go to prove what that insight, what that guidance can do as far as the growth over time. However, if you are looking in hindsight at 2021, the things that did great last year are growth, things that are not working this year.
Right.
Your large cap growth is not outperforming this year.
No.
And you are experiencing every bump and jostle and twig and branch in the road because of the different market conditions that we are in this year.
And value has kind of, it's been better than growth, although down, but better.
And within the 401ks that we are managing, Lee, you have said we are being way more nimble. We're pulling back on risk because we can do that if we're the advisors on these 401ks.
I pulled back on risk a few weeks ago, 3 weeks ago or so, on the 401ks. I didn't go to cash or anything, but pulled back on a little bit of the risk just in case, just because, September's not great. I had a feeling we probably ran a little bit too hot. Let's just see what happens. And so far, so good. I'll get back in and we'll get more allocated. But there are things that we do. And
lastly, though, you hit on such a great point that I want to emphasize. Going all cash is never the answer. And so, Joshua, I understand that you're nervous, you're uncomfortable, you're seeing all these fluctuations, especially if you have outside investments apart from the 401k.
Right.
We have solutions for fixed income where you can limit your downside risk, but still participate on the upside. So my first piece of advice is give us a call. If not us, why not? But also someone who's a fiduciary, a certified financial planner, that's who you need to be talking to because you need some help.
All right, so some ideas that we've talked about in the past. Let's look at some stock ideas. I have to tell you, there are several ideas that I do like. And Moderna, which was on my Sexy 7, I want to show folks, I bought Moderna probably right around, wait, I want to go back. I bought Moderna the first time around 140 something, and I don't remember when. I think it was right around here. So June. You know what? No, because I bought it on when it was breaking.
I was going to say, I thought you bought it earlier than that.
I bought it right here. All right, this is where I bought Moderna, which was March of this year. I bought it around 140 and change-ish, and the stock made a big run and then sold off, and then made a big run, and I wanted to sell it here. I was talking to my guys in the office. Guys, just
stop it. Keep moving.
Okay. I mean, Nikki and Justin and Jared and Aaron. So I was talking about, I should have sold the stock. I didn't do it. I should have made money. Anyway, I ended up, it did peak out at 197, but I did sell it here at 183. So I bought it at 140 and change, sold it at 183, made a good return on it. I think down at these levels, down here, the 139, I did buy a bunch today. I bought a bunch today at 138 and change, plus or minus a few pennies, and we closed a little bit up today. But I think, the chart looks like crapola, but here's what I look at. This stock is trading at 4 times earnings. 4. And they're growing their revenue over the last several quarters enormously. But they're still going to grow. Last quarter, not great, but they are growing their revenues tremendously. I think it's an opportunity, but again, not a recommendation because we don't know you.
But we want to get to know you.
We do want to get to know you. Do you make a comment on that?
I do, because of the fact that medical care services within that CPI number jumped. They were 0.8% for the month of August, but they're up 5.6% from August 2021. I don't know about you, but I maybe put off one of my dental cleanings or an annual physical just with all of the pandemic craziness. So we're really seeing that resurgence back within healthcare broadly. However, with Moderna, it's not only just that in the sense that that's an innovative company that is really exploring what mRNA can do for so many of the ails that, plague us.
Yeah, I mean, it's
innovative technology.
I think that, and again, nothing I'm saying tonight or we're talking about that we expect to move next week.
No, exactly. We're really long-term focused.
Yeah, and when I say long-term, I think a year from now, Moderna is going to be way higher. I'm not going to put a price on it, but I think it's going to be way higher. It could be, look, it was just at 183. That's where I sold it.
I'm with you. And personally, I have the benefit of so much time in front of me before I'm accessing my retirement funds or my investments that I can afford to do this.
It may not be appropriate for a Joshua at 62 years old.
I don't think it's appropriate for Joshua.
May not be, unless we talk to him.
Knowledge that I do know.
Right.
Single stock risk for someone who is in the twilight years of approaching retirement, this would not be applicable. Single stock risk is the most risk you can take. Any company can fall apart.
Here's a stock I think is really cheap. Look at this.
I love
finding
this.
support. I think Google is, whether there's a recession or not, it's going to do extremely well. Just executed a 20-for-1 stock split. I bought some today.
I think I'm
for
gonna
some
average
clients.
down on my
What I
position.
did is some clients that maybe didn't have enough. I bought another whatever,
Yeah.
50, 100, 25. I bought some shares today at these levels. And again, not a recommendation, but it is something that I think could do really, really well because I think that they are pretty much recession resistant.
So they might not be recession resistant from the sense of digital advertising, the dollars spent by corporations, because of the fact that Alphabet
all the
and
other
Facebook,
stuff.
Meta, have a duopoly within digital advertising. However, they own YouTube. Do you know what people are going to do in a recession when they cannot spend money outside? Spend time in YouTube rabbit holes. So Alphabet, they are doing everything right. And if you can, I think this is a perfect opportunity to get in, to average down.
And
I don't care what
And
it
for
is.
those of you that said, oh, it's too high of a price stock at 2,000. Okay, now it's 100.
105. So I don't want to hear it.
Okay.
And also, too, the fact that you're looking at just the price tag, not relevant.
I love healthcare. All right, I love healthcare. We've talked about that. But I want to go into,
Yeah. You little tree hugger.
I sent you this chart. This is something I've been talking about now for probably a
Wow.
couple of months, and I own some personally. But by the way, everything we talked about tonight, I own Apple, I own Google.
I own all of it, and I own ChargePoint.
I own Oh, you do own ChargePoint?
In my Roth.
I own Google too. I don't remember. I think I own them all.
Yeah.
But I think ChargePoint is going to be, I really, truly, no, okay, I'm not going to even, I'm not going to go
Come
that far.
on.
I'm going to say I really like the stock. And
Why do you like it?
I think that it is the fact that everybody's going that direction.
We are literally using our infrastructure
Money
bill
for
that.
this.
Yeah. You saw one in the wild too. You
I
sent
did.
us all
I took a picture.
I've never seen one in the wild.
In a
That's
park. It was a
awesome.
parking lot.
I was like, whoa.
Yep.
I was like, I felt like the crocodile hunter. I was like, she's a beauty.
It was a parking lot in Hawaii, and they had ChargePoint charging stations. So
amazing.
stock, and look, here's what I look at. If it breaks 1927, which we're getting really close, it's going to, the next resistance would be 21, and the next resistance after that is 28. I think this is an EV play without
Having to pick a
fighting
winner.
over which EV companies would be
Right.
the best.
Yeah, because
They're
now-
all going to need this.
Exactly. And now every legacy automaker is getting into the EV game, and they're all going to need electrons to charge the cars that they are producing. I mean, California just came out and said that they're not going to allow any more new gas cars to be sold after, I think it was 2030.
Yeah. And however, they also did say that we encourage you not to charge your EVs because
Right,
they have a
so-
power issue.
As Gavin Newsom did that in a fleece sweater in the middle of the fact that they're trying to say, like, please conserve your energy usage.
my God.
Don't use your AC. Like, wherever he was probably had the AC on like 65.
Next one I really
a good
like.
look.
I bought some of this today for some clients that didn't own it. Occidental Petroleum. We've been buying it. We own it. We own it really, really cheap. And there's no doubt that with Warren Buffett on top of this, Warren Buffett just added to his position. He is now a 28% shareholder, and he did ask the SEC and got permission to own up to 50% of Occidental Petroleum. The stock pulled real quick
This
before you go,
is
Nick. Real quick, it went right down to the 50-day moving average. I just think that this is probably a no-brainer for not a high flyer. It's not going to go quickly, but it's going to be a nice, consistent mover, I think.
All right. So before I jump in on about Warren Buffett, so I was listening to CNBC today, and I heard someone talk about how they were inflating the percentage of a portfolio that they were allocating on behalf of a client for the energy sector.
Okay.
How much of a portfolio do you think should be allocated to energy currently in today's market conditions for maybe this next wave, the last part of the year? What would you say?
I think it's got to be S&P weighting, because keep in mind, S&P weighting may be about 10%. I don't know. But that doesn't mean you should have 10% in your portfolio because you don't
No.
have all S&P. You may have some
Right.
bonds in there.
But energy has been the thing that's consistently worked this year.
but it hasn't for many years.
Right, but this year is different as well.
This year, we don't know what's going on. All right. So what I'm saying is, so if somebody had a $500,000 portfolio, I would not have a problem them having $25,000 in energy, 5%.
Exactly. That's where I'm with you. They were saying something about like 10 to 15. I was like, that's too much.
I don't agree.
But I think this year, every portfolio needs to have some energy out.
Because understand what they're talking about is, I think,
macro issues.
But what I think they say is that when you say it's $25,000 or a percentage, 10%, right. You're talking of a whole portfolio.
Right.
We're not, because none of our portfolios are full stock market.
True.
I think they're talking about still full stock market.
The ones that are exposed to equities, like of the equity exposure, what percentage of that?
Of the equity exposure? Of the equity exposure, you could be 10% of the equity exposure. Meaning, so if you are a 50-50 portfolio, 50%, 500,000. You have 250,000 fixed income, 250,000 equities. Then I could certainly say $25,000, which puts it 10%.
Yeah.
Which is saying 5% of a regular portfolio.
Heard, and I agree. And I think that this is a great time to get into a wonderful company that, I'm sorry, I don't mind riding the coattails of the greatest investor of my generation at all. And I think
he's way past your generation.
No, he is. He's alive. Well, I'm alive. That's my generation.
All right, but Nick, I want you to look at this something real quick. These are the earnings in the last 4 quarters of, I want to underline them. Earnings increases, 79%. Hold on, I'm sorry. That's revenue increase, 78%. Earnings, 880%.
That's disgusting.
Revenue. Now, they came from the depths of hell.
Because energy hasn't worked for a while.
Right. 139% revenue increase. Boom. Look at their multiple right now. They're trading at 9 times earnings with, now they are going to go down an earnings estimate for 23. So that's maybe where the stock is trading right now. But we're going to see at the end of 22 a huge gain. So at 10.79 in earnings, let's just go for shits and giggles. All right. I was listening to the R. Kelly song. Okay. 10.79 in earnings times 9 puts you at $97.
Significant move.
10.79. That's how it works. Mm-hmm. Your earnings are 10.79. That's the P of the E. Price is how you get P divided by E. So if you inverse all that, you take the E and you multiply it times the price earnings, and you get the P.
Yes.
So that comes out to $97. I think the stock is going higher.
I don't know if this is an own. I think it is, because I think eventually Warren Buffett is going to make this the hedge of Berkshire Hathaway, his legacy. However,
I'm sorry. Be more specific. You don't think it's you're not sure it's an own, meaning we have an own or a rent? Own or rent,
yes. Okay. So I think, though, for this year, it is for sure a rent, because you're going to ride that up.
I agree. I think the energy sector is never an own.
Right.
I wouldn't own Oxy for 10 years like I owned Apple.
Go in and out of it. It's not something that you're long-term holding, correct? Which is so opposite of what most of our positions are, or how we feel about investing.
Yeah.
So,
all right, we're gonna wrap things up. The last one, we talked about it last week, and I watched it pull back. I'm thinking I'm going to start pulling the trigger on this a little bit.
I mean, healthcare costs are going up. We got to clothe the people that are in the industry.
This is figs. I know that your sister is an RN.
She is, and she loves figs. She's the one who told me about them. They are the Lululemon of scrubs, and every time I'm in a doctor's office, I'm seeing figs. I'm talking to the nurse. Oh, what are you wearing? Like, I really love your scrub top. So cute. They always say figs.
Okay. Well, that's what we're talking about.
That's what triggered it. I was like,
So I want to encourage you.
Cheap. They are the Lululemon price tag.
I'm sure they are. And we, you know what? We didn't have, seemed like a lot to talk about tonight, but we said, let's do it. And thank you very much. And, we were off last week, so we had to kind of catch up. Thank you. We'll be back next week. We'll do another show. And we appreciate if you guys share this and just spread it around, because we try to educate, and that's our goal. And we're going to have a lot of other events, online events for women in investing.
In-person events.
In-person events, estate planning things. We're going to do a lot of things, because we are a financial planning firm. We have money management focus. We have a certified financial planner right here. We have a tax side of our business where our clients can get their taxes done. So we really hope that you guys
do it all in-house.
take a look. And we do actually do it all in-house and our affiliated companies. But you guys are awesome. Thank you very much for joining us on a Hump Day Market Update. We will see you next week. Thank you.